hedge funds gotta hedge because we don't want our clients to leave.
Well, I mean, they don't, but that's not really why they hedge.
We want our clients to feel like they're protected by every complicated hedge option that exists.
Well, it's not really that simple.
Yes, that is, after all, what funds do.
Well, that's not really what...
They're paper-handing sissies.
Hey YouTube, welcome back to another episode of Pirates of Finance. Now before we begin, would you be so kind as to go ahead and hit that like and subscribe button? You know, before you even watch the video, really know who we are, or whether you even like us. Thanks, that'd be awesome. To hedge or not to hedge? That is the question. This very question sparked a violent debate on Twitter between quantitative hedge fund titan Cliff Asness and professional author and ex-option trader Nassim Taleb after it was reported that the California Public Employee Retirement System had cut about half of their tail hedges right before the March 2020 crisis. Now, Cliff argued that empirical evidence suggested that tail hedges were prohibitively costly. Nassim argued that empirical evidence really wasn't relevant when you're talking about a type of protection that offers massively asymmetric payoffs in really rare events. A year later, as markets climbed towards all-time highs, we thought this would be a great time to revisit the debate. Now, full disclosure, both Jason and I utilize tail hedging within the funds that we manage, so we're a bit biased. As a first test, we thought we'd take data from 2009 through 2019 and implement a really simple tail hedging strategy using put options. As a reminder, put options are a simple contract that give the buyer the right, but not the obligation, to sell a security to another person at a pre-specified price. At expiration, the put option will be worth the difference between that price, known as the strike, and the price of the underlying security minus the premium we paid for the option. This increase in value can help offset losses we have from owning the security itself. Our strategy was simple. We bought the S&P 500 and then every month would buy enough 3-month put options such that if the market fell more than 15%, our portfolio would be entirely protected. This is the result. It's an absolute catastrophe. So the answer is no. Thanks for playing. Hope you enjoyed the video. Don't forget to like and subscribe.
Hold up. Wait a second, Corey. Not so fast. First, there's a few nuances we need to discuss with this backtest. One, Corey and I purposely chose 2009 to 2019 as probably the worst period for SPY plus puts. We purposely got rid of the 2008 recession and the 2020 crash. The other issue is not a lot of people are gonna hold 100% S&P exposure, so it's maybe not the most appropriate comparison. What we really wanna look to is comparing the 60-40 over the long run to SPY plus puts, because in that scenario, when you have that negatively correlated protection of puts, you're allowed to hold more S&P exposure. The best predictor of nominal returns for bonds over the next 10 years is current yields. So at current yields at 1.5%, it gives us a good indication of what the nominal returns are going to look like 10 years hence for bonds. Here's an interesting piece by Research Affiliates where they looked at bond markets around the globe and find similar conclusions that current yields are the best predictor of forward nominal returns. So the question is, as we get closer to the zero bound, are bonds going to really be that ballast to your portfolio anymore? You know, they're not necessarily going to have that much of a positive carry, nor are they going to have the convexity to ballast against the S&P exposure in a sell-off. We also have to really think about the path dependency of sell-offs or recessions. If we look at 2008, the puts are not going to be quite as protective as the 60-40 in that scenario when you have a more protracted recession or a long, slow drawdown. We'll talk about later about maybe diversifying our diversifiers a little bit. But if we look at 2020, when you have these liquidity events and you have such a sharp sell-off like March 2020, that's when puts are really going to save the day. So the question really becomes, what helps me sleep at night when markets are selling off, and how will I react correspondingly? So when sell-offs happen, what's the Mike Tyson quote is everybody has a plan till they get punched in the face. You know, in scenarios like 2008 or 2020, March of 2020, People are in the fetal position on the floor when their portfolio is tanking that quickly, and they don't know what to do, and they get into a paralysis mode. Eventually, they hit a absorbing barrier where they sell out of the portfolio. They just want to go to cash. They've had enough. And usually that's typically, unfortunately, the low point in the market. Then they're also so gun-shy that they're not going to be invested in the market for a subsequent return in equity or bond prices. Therefore, they're missing out on the compounding effects of their wealth over time, because we make very emotional decisions when our life savings and our retirement savings are crashing right before our very eyes. So that's maybe the best way to think about puts, is it provides you like a convex cash position or that insurance, so that way you can think more rationally or logically. More importantly, it gives you a broader opportunity set after you're sitting on that convex cash position that you've gotten from your puts. You can now redeploy that into other assets that may be at their low NAV point. And this is what really helps compound wealth over the long term. In this Value Walk podcast with Aneet Chopra, he talks about that value of having liquidity there during a crisis.
But the other thing that I think is less appreciated, that what having some hedges on helps you with, is it helps you take advantage of market opportunities when there's crisis periods. And so what I mean by that is, if you're facing that your portfolio is down significantly during a crisis period, even if there's attractive opportunities out there, you're going to be very reluctant mentally to add to them. But if you're in a position where the hedges are helping you and they're smoothing out your returns, then it makes it much easier to add on to positions at attractive levels.
Corey, if I go to Dr. Google or I look at a textbook, they're going to tell me puts are expensive. I think we always deal with relativity. So what does puts are expensive mean to you?
I get really frustrated when people keep comparing puts and equities versus equities, when in reality, no one is really, that we come across, ever holding just equities. They hold a diversified portfolio of all these different things, of stocks and bonds, in a blend that sort of helps them underwrite the risk that they're willing to take. So why isn't that the benchmark?
Or as we see all the time, it's like, or they look at puts in isolation, right? And nobody wants to do the hard work of including it in a holistic portfolio. So if you look at puts in isolation, you have that negative line item every month or every quarter, every year. Yeah, it looks horrible to pay that price, but you're saying like in relation to what? The other way I always like to talk about it is people say puts are expensive, or they're overpriced or underpriced. And I always say, how could you know except for in hindsight, right? If you're running along in a risk-on environment and nothing happens, and then in hindsight, you can go, puts were overpriced, so you should have been selling volatility, right? Until you have that phase shift, that market sell-off, and then puts were dramatically underpriced.
The point you just made, though, I think is really critical, this idea of looking at puts in isolation versus within a portfolio. There's this whole problem with traditional portfolio attribution analysis, which is, let's say, as an example, we go into March in a portfolio that's stocks plus puts, and March 2020 happens, the puts explode in value, we sell them and monetize them to buy equities, and then equities rip for the rest of the year. And you do an attribution at the end of the year and you say, wow, equities added a ton of value. Well, did equities add a ton of value, or was it that you were able to monetize your position to buy a ton of equities? And that linking between who gets credit, is it the puts that get credit for the extra equity you were able to buy, or does the equity get credit for the return, is actually a very non-trivial problem from an attribution perspective. And most people don't actually look into, when they're doing attribution, how that's accounted for. And I think that's one that goes largely missed in this discussion.
The tail hedge allows for a bigger slice of stocks in the investment pie than the 60-40 portfolio, because the stocks are protected in a steep sell-off. The tail hedge portfolio thus indirectly and counterintuitively beats the 60-40 portfolio, as well as most alternative investments and other supposed low-risk things. And as you can see here, it beats them when stock markets rise and when they fall. And importantly, after the fall, when everyone else is selling their stocks, notice how the tail hedge has created all this cash or liquidity to use to invest in more cheapened stocks.
I think, again, it has to go back to that. What risk are you willing to underwrite, and what are the costs of doing that? So bonds today, right? If I were to take a 60-40, what is the actual opportunity cost that I'm giving up in not allocating more to equities, right? If I think equities are going to return 5% and bonds are going to be 0, where does that 60-40 really leave me at 3%? Okay, so what's the other choice? Well, if I think a 60-40 gives me an expected return of 3, is there a combination where I can buy equities and burn 2% a year with puts and end up at the same 3%? And is that portfolio potentially better? I want to talk about the path dependency idea, because I think that one's really critical. This idea of getting people to put on insurance, again, I will argue all day long, if you sell stocks to buy bonds, you've already made that decision. But that decision comes with its own path dependency. An asset allocation like a 60-40 is going to behave very differently than a SPY plus puts type portfolio. But again, this is not black or white. There can be shades of gray. You focus a lot, I focus a lot on the idea of ensemble trades, diversifying your diversifiers. What do you think, sort of, as you think through the different path dependencies? I know it's hard to set sort of broad expectations, but what do you think about maybe the big classifications and the expectations for when those different sort of insurance type trades might pay off?
Yeah, I think you actually wrote it best. It's a liquidity cascades, right? When liquidity dries up, what happens in the markets, and the more specialized and financialized we've gotten with our markets, the more liquidity cascades are likely to be in our future, where liquidity really dries up. And so if you look at from an institutional side, if they have a lot of their money in private illiquid assets and a liquidity crisis happens, they need liquidity. So you have to think about what side of your book is providing that liquidity. I would almost argue that happens on the retail side as well, because most of their wealth is tied up in their home, which is illiquid. And so when markets crash, you need a provider of liquidity. So you can look at, especially going from a risk on to a risk off environment, your put options can provide an amazing amount of convex liquidity. We've talked about it often. I think it's like you're inventorying liquidity, waiting for an event to happen. That's what holding your put options are. And a lot of times the markets have become so financialized and everybody's moved so far out the risk curve, and most of them are selling derivatives to try to increase yield into their portfolios, that the sell-off can be so violent. You really need something that has that positive asymmetric convex profile like a put to ballast the portfolio instead of cash prior, right? But then to your point is, you can use that in that sell-off to provide that convex position, but then you can use things like liquid bond portfolios too if you just need liquidity. You can also use things like cash if you need liquidity. Those are great in times when liquidity is scarce and you just really need liquidity. So I wouldn't necessarily think about bonds as a return driver, a yield enhancer, or even a ballast of portfolio. I just think about it as a way to source liquidity for institutional sized portfolios when they need it most. So you can use this, like you're saying, ensemble. You have cash, you have fixed income or bond-like assets, you have your put protection, and then you can have different ensemble approaches to options as well. But then you also have like commodity trend advisors that are going to ride that trend in a prolonged recession. So it's not so simple as thinking about what's the perfect hedge. It's once again using an ensemble of hedges, because the path dependencies of sell-offs are so different, and we're always fighting the last battle. And so if you try to build your portfolio for the last battle, you might be surprised by the next one. Like as we started this conversation with, is 2008 was a more protracted or prolonged recession where commodity trend advisors would do better than puts would. But in March 2020, the puts are going to do so much better than commodity trend advisors, just because of the quickness or violence of that move. So that's why you need that ensemble approach. And I'm curious of your thoughts. I was actually talking to our mutual friend, Dave Nadig, the other day, and what we brought up is like, it's almost vol parity now, is you have all these implicit short volatility assets like stocks, bonds, private equity, venture capital, and a lot of illiquidity there. And then you could pair that with equal amounts of highly liquid long volatility strategies, but using an ensemble approach as well.
You may not have enough cash holdings to meet the spending commitments that you have. Mm-hmm. And you can't get out of your traditional alternative investments like private equity or venture capital or real estate. And then if you're selling stocks, you're selling them at a big discount. So it makes sense to hold things like bonds or liquid alternatives that you can exit during a crisis period without taking a big price hit.
I have this really hokey framework. The way I think about risk is sort of like this ball of Play-Doh. And there's these different regimes, though, that the way you build your portfolio, you're basically taking the Play-Doh and moving it around and saying, I'm willing to take risk in this given regime. I think the more that you sort of adopt that vol parity type idea that you just talked about, especially long vol parity, you're kind of just taking your hand and smashing it down on the Play-Doh and smearing it out, right? And I think what has happened is the 60-40 portfolio, for example, all of that Play-Doh is sort of concentrated in one regime, right? That you have disastrous economic growth, you have economic contraction and high inflation. That is where all the Play-Doh is. And the problem is that really has not existed for the last 30 years. It's hard to say there's been a real catastrophe in US equities when markets bounce back really, really quickly. I think if we're trying to take a less sort of historical view and say the future could be anything, well, wouldn't it make more sense to have less of our risk balled up in one particular regime and maybe take our hand and smash it and smear it out and say, I'm willing to pay a premium in all of these different regimes to make sure that there's no catastrophic risk lurking out there. And that's sort of the way I think about the more ensemble approach, that it's not just buy puts, which short dated puts maybe wouldn't have done all that well in 2008. It's not just go long bonds, which maybe wouldn't have done as well in March 2020, but by the way, also cost you a lot in 2013 when the market was up 30, right? There's a big opportunity cost there and potentially going forward. It's not just CTAs, which struggled for the last 5 years, and by the way, we're doing phenomenally well in the last 5 months. It's making sure we're diversified across more than just what we're investing in, but also how we're investing and when we're making those decisions. And to me, a resilient portfolio ties into that more holistic view of diversification. If you're going to have this way of managing the downside, does it actually allow you to take more risk to the upside?
Yeah, that's exactly the point, is like you actually couldn't buy a beach house with a mortgage, right? The mortgage is only going to be provided if you have flood and hurricane insurance on that beach property. Otherwise, everybody had to pay cash and then the prices would come down. But because they're allowing leverage for you to mortgage this long GDP asset, but provide the insurance to protect the people that are providing your mortgage, that's what accelerates the prices on coastal real estate. Another way to look at it, I was reading about car insurance the other day, and the average insurance policy is only used maybe once every 18 years on average. But we still pay the monthly premium every day because we never know when that catastrophic event's going to happen in our lifetimes. But what's more interesting to me is it's like, not only do you want that hedge in case you get in a car accident to have that insurance in place, but the other part of that hedge is you don't know what your personal liquidity situation is going to be in that scenario. And that's the whole concept. So if I'm going along and my normal income is slightly variable, it's up and down, my savings are up and down, and years hence I get into a car accident and all of a sudden it's $100,000, $250,000. I don't know what that bill is going to be, but more importantly, I might not have the cash liquidity I need to service that accident premium. But that's why I have the insurance, because I don't know if there's going to be a mismatch with my liquidity profile when the day is I get in an accident, because I can't know when that day is. So we go through life, we have car insurance, we have home insurance, we have life insurance, but yet for some reason we don't want to buy portfolio insurance. It's never made sense to me. And I think recently Nassim Taleb came out and said it very simply. He said, if you don't have portfolio insurance, you don't have a portfolio.
That said, Jason, I will argue, this is a hill I will die on, is that anyone who owns a 60/40 is already buying some form of insurance.
And to touch on what you started with Asness and the Taleb debate, you and I end with both.